Okay.
Thank you, Bong Zeman. Good morning, Dr. Professor, and everyone. My topic is Advanced International Financial Reporting Standard, IFRS. Next slide, please, Bong Zeman. Yes, what is IFRS? IFRS are a set of globally recognized accounting standards developed by the International Accounting Standard Board, IASB, in 2001. They provide a common framework for financial reporting, ensuring consistency, transparency, and compatibility of financial statements across country and industry. This framework aids investors and stakeholders in assessing financial performance. Next, please, Martin. There are over 15 standards in IFRS. Martin, please, next slide. Yeah. There are over 15 standards in IFRS. We don't call it chapter like a traditional book, since each of them address specific aspect of framework of financial reporting report. For my section, I would like to take only three key standards to talk. IFRS 9, IFRS 15, and IFRS 16. Next slide, please. IFRS 9, financial instrument. Financial instrument are contracts that hold monetary value and can be traded or settled. They are classified in three classes. Equity securities, present ownership, commonly presented by stock. Debt security, present a loan made by investor. Hybrid instruments, combine feature of both equity and debt. Example, convertible bonds and preferred shares. IFRS 15. Next, please, Benjamin. IFRS 15, revenue from contract with customer. The objective of IFRS 15 are establish principles for recognizing revenue based on the transfer of goods or services, enhance comparability, and provide useful information about revenue and cash flow. There are 5 steps in recognizing revenue that is called 5-step model. First one, identify the contract with customer. Determine whether a contract exists that creates enforceable right and obligation. Identify performance obligation in the contract. Identify distinct good or service promised in the contract, which are known as performance obligation. Determine transaction price. Establish the amount of consideration an entity expect to receive in exchange for transferring the promised good or services. Allocate the transaction price to performance obligation. Allocate the transaction price to each performance obligation based on their relative standalone selling price. And the fifth, recognize revenue when or as the entity satisfies a performance obligation. Revenue is recognized when control of the promised goods or services is transferred to the customer either at a point in times or over time. Next, IFRS 16, leases. The objective of IFRS 16 are leasing accounting. Required to recognize lease on balance sheet. Required to recognize a right of use asset which present their right to use the lease asset over the lease term. Lease account. Required to recognize lease payment as income on a straight line basis over the lease term. Required to recognize the lease receivable and recognize interest income over the lease term. this IFRS allow for short-term and low-value lease exemption. The impacts of IFRS adoption. First one, financial statement presentation. Increase transparency, comparability across borders. Second, changes in financial metric affect key ratio and revenue recognition. Third, balance sheet effect. Require recognition of new assets liabilities. Operational changes necessitate revision in accounting policies and training. Regulatory and compliance consideration involve increased disclosure and scrutiny from regulator. Six, impact on stakeholder, enhance investor perception and may influence credit ratings. Global business operation streamlines reporting for multinational company and attract foreign investment. Then transition changes involve implementation costs and complexities in data conversion. That's all for my section. The next section will be covered by Rangsai. Thank you.
Thank you, Keaheang. Thank you. Business, so how are we gonna approach? We're gonna discuss something.
I think each module or each section that you finish, maybe we can open 3 to 5 minutes for discussion. Because if you go through all, maybe we don't difficult to come back. Okay, so I think we should open the floor.
Okay, so
if you have any question. So let me my first question, what difference between the full IFRS and IFRS for SME?
The difference is IFRS very longer than IFRS for SME and updated regularly, but IFRS for SME updated every around 5 years.
And what else?
And I just want to add also, IFRS for SME are more exempted. It's less complex or less requirement. For example, IFRS 16, related to list. IFRS for SME is not required for implementing that one. However, full IFRS is required for list, IFRS 16. Is that correct, here?
Yeah.
Any other thing? Anyone to add or to share more about the difference between the full and
IFRS require many disclosure than SME, and amended every year.
Any other want to share more?
No more for this question.
So full IFRS, I mean, to fully adopt full IFRS require a lot of resources, first of all. So because a lot of disclosure need to be happening, more technical. I mean, just an example of calculating fair value of the account receivable is very complicating, right? I don't think IFRS for SME require to prepare a fair value unless we see it very, very serious. But the full IFRS always require to look at all of those.
Yeah. Other member in group, if you want to share, you can jump in and then you can have discussion as well. But let me give some comment a little bit, about full IFRS and SME. Actually, for full IFRS, the scope, usually apply for the large company, for example, like listed company, bank, insurance, or what they call public interest company.
Mm-hmm.
For example, in Cambodia, listed company, the company in foreign exchange, in the stock market, insurance, banks, financial institutions. So they all required to do the full IFRS. And for SME, it's quite simple accounting standard. Quite simple. It is apply only for public interest company. Like normal company like trading company, import, export, that are not in the banking sector or are not in insurance or are not in stock exchange market.
Stock exchange.
So they can apply IFRS for SME. However, the small company can choose full IFRS. And another thing is complexity, like you all mentioned, it's about, for example, like loan. For SME, you don't need to calculate the market value, don't use the effective interest rate, but the full IFRS, the loan you need to calculate present value, you use discounted cash flow, everything. For example, another thing is about rent. For rental, for SME, you do a flat rate and calculate average rental price over the life of rental. But however, for full IFRS, you need to calculate right of use asset, lease liability. Those are the difference. This is just an example and sharing from my thought, my experience, my knowledge. Okay. Okay, so if all of you have further sharing, you can. If not, because we have 6 sections, so we should continue and discuss further for the second and third section. But if you want to come back, we can come back. Okay, Smen. So let you lead. So you can decide to move or you can decide to stay in the section 1.
Okay, so yeah, I think it's fair right now, and thank you, Visna, for adding a little more the difference between IFRS, full IFRS and for SME. Many things more to learn. Let's move to our second topic, where Rangsai will do the presentation. Allow me to share screen.